in trading, you don't know what weight class the market's going to operate in that day. Just like you don't know what indicator it's going to respect, which is why it's nonsense to even believe in that. So you have to take it back down to, okay, what is it likely to do? Okay, it's going to move a lot of momentum, one directional, at very specific times, between 10 o'clock and 11 o'clock in the morning. Why? Why does it do that? Because at the 9:30 opening, a lot of orders come rushing in. Big trading firms and clearinghouses, they funnel a lot of orders in there because why? There's liquidity. Everybody's chomping at the bit to get in or get out based on that opening price. And that brings in a lot of liquidity that allows for order flow to come in real quick. But it will evaporate quick. So what does it do? It uses that initial surge of inflow of orders to run to the obvious liquidity that's above or below the marketplace. What is it reaching for? Many times it's the opposing direction of where the daily range will reach for. So an example would be, you're looking at a marketplace and your ideal scenario is you think the market's going to go higher. So you're not trying to go short. You really want to wait and see what it does at the opening price. That initial opening, 9:30, opening bell, everybody's in there clamoring to get in there and do something. All kinds of order flows coming into the marketplace. Boom, 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 boom. That will evaporate. So what is it going to do after that initial surge of interest and all the clearing firms that come through with their orders hitting the marketplace in the first 15 to 30 minutes? What is it going to do? It's going to reach for the resting pending orders above the marketplace, above a singular high or above relative equal highs. So what is that initial move dropping down at 9:30 to 10 o'clock? Judas. It's a fake move. So you're waiting for all that stuff. But then at 10 o'clock and 11 o'clock, you have that distribution phase of the morning price swing, where whatever it's going to do in the morning going into New York lunch, it's going to be directional, and it's going to run real quick into that buy side, up to, but not limited to, 11 to noon, New York local time. Now, that is a very generic perspective to hold in the marketplace. But if you look for that when the market's predisposed to go up, you got it locked. The only thing you're waiting for is a fair value gap to wait for the price to drop down into on a 5, 4, 3, 2, 1 minute, or if you're inclined, less than a 1 minute, 15 second, 30 second, 45 second, 5 second time frame. It's not complicated, folks. It's really, really simple stuff. But the complication comes with you're trying to find where COT fits in all that. Where does the commitment traders fit in all this, ICT? I'm really struggling with the break of market structure. Where's that in the turtle soup? I'm sorry, not the turtle soup. Where's that in the silver bullet? Where's that? It's not there. You're looking for liquidity. You're looking for liquidity. You literally can wait between 10 o'clock and 11 o'clock and say, okay, what has already happened? Sell side's been taken. All right, am I bullish? Weekly expansion is likely to, I'm wanting to see that weekly candle go up. Okay, then I have a selection that I want to be a bull. I want to be buying only. So you filtered out every shorting opportunity. I don't care how good it looks, you're not taking it. And that's going to be hard for you to see a lot of these really dynamic sell-offs